All right. Well, good morning, good afternoon, or good evening, depending on your perspective on the world. And welcome to Trading Coach's Playbook. This is Brandon Wendell with you this afternoon or morning, again, depending on where you are, just about noon here on the East Coast. So, welcome everybody. And hello, John. Hello, Kevin. Hello, Helen. Welcome, everyone. Got a nice group here. So before I get started, I just had to put out a little warning here, a little statement, and just let you know that we are not registered broker dealers or investment advisors. And I'm going to take a look at the markets, but I'm not telling you to buy, sell, or hold any of these securities. These are not recommendations. I'm simply looking at the markets from an educational standpoint. That's all. And any mention of a security is not a recommendation. Also, all trading and investing does involve risk in the markets. And as I mentioned, no matter what we can do, we're going to try to minimize risk. That's what I mentioned in the title, scaling positions to minimize risk or manage risk. We can never eliminate it. That's unfortunate, but that's the way it goes. Also, we are not subject to trading restrictions. I can have a position open or initiate one at any time without any warning. So that being said, we'll continue on here. And hello, Robert. Welcome. I just want to mention we do quite a few things here at Wealth Builders HQ. As you can see, we've got a lot of premium online workshops going on throughout the month. We have a mastermind group that meets up regularly as well. I actually am in charge of a program called the E-Mini Think Tank, and I'll talk a little bit about that as well. That's on Monday, Wednesdays, and Thursdays from 9 a.m. to 11 a.m., where we look at the markets and analyze the markets in a live environment and see what opportunities are out there and educate ourselves further about how the markets work, and about, most of all, look at certain strategies that I've found throughout my years of trading that increase probabilities of success. Oh, I'm actually working on, if you see my background that I've got here, that's actually a painting that I did. And what I'm working on right now is a canvas print of that, so I'll be able to sell those. And that's almost done. The canvas print is almost done. I might be able to actually just do a print of the mural, but it may not be of high quality. So that's what I really want, is a high quality print. I'm going to have people have access to those, but should be within the week. Next week, I think I'm going to finish it this weekend. It's almost done. So yeah, let's keep an eye out for that. Have been getting better. Thank you. Appreciate that. Yeah, I'll let you know. It'll be on my Twitter or my Facebook. And if you're looking for my Twitter, it is at Trader B-Dub. That's my Twitter. Of course, you can stay in touch with all of us here at Wealth Builders HQ. We got a lot of different social media outlets for you there as well, blogs and websites, things like that, podcasts even. So stay in touch with us. And of course, you got my Twitter, like I mentioned right there, the at Trader B-Dub. You can find my professional profile on Facebook as well under Brandon Wendell CMT. So kind of jumping right into this, we've only got about an hour together. This is kind of a short session, just talking about something we can do to control our risk, because let's face it, we cannot control whether the markets are going to go up or down. I mean, if you can, give me a call. We'll make lots of money. But as far as I know, individuals like ourselves don't have that kind of muscle power when it comes to the markets to actually determine the direction of the markets. So we're out there trying to anticipate what's likely to happen and play the probabilities. But the only thing that is actually within our control is how much we are going to lose when we are wrong. And you notice I didn't say if, because we are going to be wrong. It's going to happen, right? There's nobody out there that's a perfect trader that never loses money. It just doesn't happen. So we need to be able to control our losses and manage our risk, because again, that's the only thing within our control. And believe it or not, there's really only 3 things you can do to manage that risk, which in a way makes it simpler, makes it easier to do, but it also limits us to a certain extent. The first thing is size, and we can control the size. We'll talk a little bit more about that. That's really the focus of today's discussion anyway. We also have frequency, and we have duration. So when I go about risk management and talk about size, we're talking about a couple things. Number one, the number of either shares if you're trading stocks. If you're trading options or futures, it'd be contracts. If you're trading Forex, it'd be lots. And you control your amount of risk by controlling the size. The higher the size, the more risk you have, obviously, the more reward you can potentially get as well. It goes both ways. So size is one thing. Again, the higher you go. And when it says the type, I'm talking primarily when it comes to futures. With futures, we have different types of futures contracts that you can invest or trade in. We have what are called micro and minis when it comes to the futures. Actually, we have it in Forex as well. So you can change the type of security that you're trading to control the risk as well. Frequency refers to the number of positions that you take. How often are you getting in? If you are not very selective and you jump in on every opportunity that's out there, you're likely to lose more. You're risking more because you're risking getting into a bad position. Whereas if you're more selective, you take fewer positions, then you're more likely to only focus on higher quality executions and opportunities. So we definitely want to be as selective as possible. You want to avoid going the other way where you end up not taking any positions because you're too scared. So we have to find a happy medium. It's interesting because people always ask me, what's the right number of what's the right combination here? And the answer is there is not one simple answer for everyone. It's not a one size fits all. What I used to teach is, I think I actually did a workshop on this before, tuning the risk radio. If I'm not mistaken, I believe I did a Trading Coaches Playbook on this, where I refer to these as dials on an old radio, analog radios, where you had to dial them in and change the volume with knobs. So you have to dial in what's right for you. Duration, by the way, that refers to the length of holding for the position itself. That's going to be a function of the charts you use. If you use smaller time frame intraday charts, you're going to be in and out of your positions in a faster period of time and therefore have less risk. If you hold on and you're looking at daily charts and holding on for days or even weeks or months, you obviously subject yourself to more risk in the markets. So you can compensate by adjusting one over the other. Let's say you want to do long duration because you cannot be a day trader for whatever reason. Could be your account size, could be you just don't have the time or the bandwidth to focus on the markets every day. Well, you turn up the duration, you can turn down the frequency and the size to compensate for the increased risk. So when people say, what's riskier, being a day trader or being a swing trader or being a long-term investor, the answer is yes. They're all risky in their own way, but you can control them by dialing back on another aspect of your risk management. Makes sense, right? So if you're a day trader and you have a smaller duration, less risk there, you can possibly dial up the frequency of trades and or the size of your trades. Whereas I mentioned the longer time frame trader has more risk and duration, they can reduce the risk by the number of size contracts that they take or shares, or take fewer trades. So there's not one size fits all. It's not perfect, but today we're simply going to focus on the size aspect and talking about something else that we can do when it comes to that size called scaling in and scaling out and managing the size of your position. And people don't realize how much psychology really impacts your investing and trading. It really is probably one of the biggest influences on that, to be honest with you. So if you understand a little bit more about your psychology, and I'm not just talking about mass psychology, that's analyzing the broad markets, mass psychology, looking at what the broad markets are going on and what people in mass are doing, what they're thinking about those overall markets. But you also need to understand your own personal psychology and how you react to certain stimuli. How do you react to winning positions? How do you react to losing positions? What's your frustration level? One of the things that many people overlook is how are they feeling mentally and emotionally when they're trading. In my old trading journals, when I'd write down my trades, I would write down my entries, exits, reasons for it, but I would also make a small note of how I was feeling. Was I anxious? Was I relaxed? Was I concentrating? Was I distracted? And you start to see patterns there. And there are exercises you can actually do. And I'm not going to go into that right now, but there are exercises you can do to help yourself mentally to prepare to be a better trader or investor. And by ignoring some of those signs, we're ignoring dangers that end up costing us money. So don't overlook psychology. When you hear a little bit more about trading psychology, or actually there's a whole study on behavioral finance that's pretty interesting. You get to learn a lot more about yourself and make yourself a better person as well as a better trader. So look out for some of those resources. Maybe I'll talk about one of those in a future session, who knows. But we're going to talk about the size right now and how we can actually handle or manage risk by the way we enter and exit positions in the markets. So when it comes down to it, I teach this a lot, by the way, in a program called the E-mini Think Tank. I've been mentioning that a little bit. I'll talk more about that E-mini Think Tank in a moment. Actually, I forgot to log in here. So let me do that real quick. Bring this page over. There it is. Just bear with me for a moment while I bring this up. Because I've been involved in training and educating traders for about 20 years. I've been trading for about 23, 24 years myself. And he's nice enough there to put in the link. If you're interested in learning more about the E-mini Think Tank program, there's a link there for you. I can go in right here. It is in my Wealth Builders HQ in my dashboard. I can go to, I got too many things here. Where is it? E-mini Think Tank. There it is. And what you'll see is that not only do we meet live 3 days a week, they're all recorded, all the sessions. So you can see the trading ideas that we're looking at for the past several weeks. But I also do a lot of bonus videos that teach you the techniques that I'm using in the markets and how I'm working. You can see right here, order types and placement. There's a video on that if I click, I'll get the information about how to place orders properly, how to place the entries, things like picking tops and bottoms is in there. Hang on a second, let me fix this. There we go. Anyway, in addition to the videos, you also get access to documentation that backs up what you watched in the video. So you actually have kind of a record and notes that you can take for yourself. Well, obviously, I've taken a lot of notes and done a lot of diagrams for you to help you with your education. So that's what this is. It's a lot of education on how to identify high quality opportunities in the markets. Plus, you get that ongoing mentorship by being able to work with me live 3 days a week and see all this in practice, which is pretty cool. Anyway, oops, got so many things open here. There we go. Scaling in. Okay, first of all, when we look at a position, I identify areas called supply and demand zones. And again, in the education, the E-mini Think Tank, there are videos on what those zones are, how they work. Additionally, if you go back in the last Trading Coaches Playbook about a month ago before I was on vacation, I did a session on kind of the why behind those zones. Why are they formed? Why do they work? So it's kind of an interesting watch if you get a chance to check that one out. It's only an hour long. And you can get it, like I said, on the YouTube video, the YouTube channel for Wealth Builders HQ. So anyway, with scaling in, you'll notice I use zones. And the reason why is it's almost impossible to identify an exact area where prices will turn around. I'm trying to identify an area where the institutions had placed a large order and caused an imbalance between buying and selling pressures on that security. Doesn't matter what security it is. Okay, in this case, I took out the security in the time frame because that's irrelevant. This works on almost every security and every time frame. I even do this when I'm charting cryptos, believe it or not. I use the same techniques and it works. So what I've identified here is an area of imbalance where there was a large buyer that pushed prices higher, and there was obviously no sellers in this area, because if there were sellers there, we would have continued to go sideways. Okay, remember, every candle or chart that we're looking at is a record of completed transactions between buyers and sellers. Prices only go up because somebody wants to buy and there's no one around to sell at that price level. If you want to buy something, nobody's willing to sell to you, you need to attract sellers. You do that by raising your price. And then eventually, if it gets filled, it goes on the chart. And that's why you're seeing those candles rising very quickly. Because it's such a big, fast move up, there was likely to have been a big buy order and no sellers in this area. Well, when we come back down to that area, if nothing else has fundamentally changed on this security, think about it. Anybody who sold here in the past is feeling really foolish because they missed out on selling at a higher price, didn't they? And most likely these institutions, I didn't really mention my background, but I used to be a hedge fund trader for a while. And I also worked for an institutional brokerage where we dealt with large orders from institutions. And again, I explained this in that video, the previous Trading Coaches Playbook, where I talked about working the orders. You could never get your orders completed all in one fell swoop. You had to place small chunks or break up your order in small bite-sized pieces and execute them in a range. So The majority of the orders were probably not filled in this area. That means there are leftover buy orders for when prices return to that zone. And that's where we are going to enter. But because it's a zone, this gives us an opportunity to manage our risk and identify multiple entry opportunities. Now, you need to decide how are you going to enter this position. And part of that is based on the quality of the trade itself. So one of the things that you want to do is evaluate every position before you take it. I don't care if you're going to be in it for only a couple minutes or a couple months, it doesn't matter. You need to make sure that you're taking high quality, high probability opportunities. So we rate the trades based on what we're seeing in the markets. What does this chart look like? Do we see a big imbalance? Do we see the trend in our favor? Do we see a large opportunity for a good profit? Or are there increased risks? So again, in the E-mini think tank, I go into more depth as to what to look for and how to rate those positions. But let's say this is a high quality opportunity. One of the opportunities that we can do, or the entries we can do, is by putting a limit order at the beginning of that demand zone. We're basically saying, as soon as prices get to this area, I'm interested, I want in, I know there's a likelihood there's going to be a lot of buy orders from the institution that were left over. There's likely to be no sellers because there weren't many before, and there's probably going to be less now. So prices should jump out of this area very, very quickly. And I want in. Now, the one issue with getting in right away is, yeah, you are likely to get in, but you have the least amount of confirmation that the zone's going to work because you are literally entering at the beginning of the zone. It hasn't had any time to prove itself worthy. And you have the greatest amount of risk. Stop losses need to be placed outside of the zone. So with this type of entry, we are furthest away from where our stop loss is going to be, and we have the greatest amount of risk. So to combat that, it's almost like going to a swimming pool or a swimming hole, lake, creek. I grew up in rural Pennsylvania, so we had this little creek nearby that we used to bicycle to, and it was fresh water. It was mountain water, so it was going to be cold. And many people would go up and dip their toe into the water first. You can tell I'm from Pennsylvania because I say water with a D, right? Water. Anyway, I get teased on that. It's a Pennsylvania thing. So a lot of people, as I mentioned, would dip their toe in to see what the temperature is like before they dive right in. And this is kind of what we're doing here. Instead of diving right in with my full position, let's say as an example, I wanted to buy 100 shares of stock. Well, if I buy all 100, I'm full bore in, I'm fully committed to the position, I have the most amount of risk. But what if I want to test the water first? I put my toe in with 30 shares. Okay. Best case scenario, if I'm wrong, I've only risked money on 30 shares rather than the full 100. Worst case scenario, one of the worst things that can happen to me is it leaves from that zone. I never get any more, and I only have a 30 share position rather than the 100 share I originally wanted. I'm still participating in the move. That's fine. But I also minimized my risk to a certain extent. I should say lowered my risk to a certain extent by not exposing myself fully to the markets. Now, there are more than just one entry, so I can scale in by adding more as the zone proves to me that it's likely to work. So we have what is called I guess you can call it a zonal entry or an entry inside the zone. And what's happening here is we wait for prices to show it's turning around inside the zone. So we see the selling pressure subsiding. We start seeing buying pressure picking up. And to help us out, we may actually even drop down to a smaller time frame to kind of expand the price and see the details of what's happening. So I'll show you how that works on the next slide. But by doing this, perhaps we add another 40 shares here. Once again, if this continues to go down and fails, we're only committed to 70 out of the full 100 shares we originally were agreeing to risk. So we have limited risk by scaling in. The advantage of this now is I actually get a better cost basis. I purchased some shares at area number 1. I purchased more shares at area number 2. That lowered my cost basis. Therefore, once I get to my target, I will have greater profits. And I also have less risk. So it's a win-win. The one drawback is I may not make as much, again, because I'm scaling in rather than going all in. And I also may miss the opportunity. Now, entry number 2 may never happen. There are times where we just barely touch the top line of the zone and just run away. Again, I at least got a piece of it if I have my entry number 1 with some shares. And then the last entry, we call this a confirmation entry. You're actually seeing the zone is working. And what you're going to do is once the zone is actually leaving the area, you're going to buy as it leaves. So you're seeing that prices are working, the zone is holding, and you got confirmation the zone worked. So you're feeling a lot more confident about the move there. Now, again, the risk is you might be chasing. You got to be careful here. You don't want to enter too far away from the zone because, again, when you buy up here, you're buying further away from your stop loss. 1 and 3 have the greatest amount of risk because your buy is furthest away from your stop. Entry number 2 has the least amount of risk because you're entering very close to your stop. It also increases your reward. The drawback of entry number 2 is you must physically be there to trigger the entry. With entry number 1 and entry number 3, you can set up orders and allow the computer to do the entries for you rather than you having to be committed to being in front of the computer. So it's, again, there's not one that's perfect. It's not the right way for everybody. You just got to try it. So let's see. Paul just asked, what are my comments on taking a confirmation entry versus waiting for an immediate retest type? You mean after it leaves, waiting for it to come back again? It may not come back. And honestly, it shouldn't. If this is a good quality zone and there's a lot of leftover buy orders, we should just leave that area very quickly. So again, if you're worried about it and the risk by committing to that move as it leaves, lower your size, right? You can lower the share size or contract size or type, trade micros or minis rather than full-size contracts, whatever it is you might be trading. You can compensate for that risk by size. But yeah, for the most part, a lot of times, this is a very good zone. You will not come back after that number 3, after you leave that area. It shouldn't. Yeah, you're welcome. So this is what actually happened. By the way, this was the S&P 500 futures this morning. This is exactly what happened today on the zone. This was a 15-minute zone that I identified. Prices came back into that zone, and it gave us all 3 types of entries. You had entry number 1 as it hit the zone, entry number 2 as it turned around, and entry 3 as it left. As you can see, it never came back afterwards. So if you were waiting for another retest after it left, it just didn't happen. Okay. So again, entry number 1, entry number 3, those are pretty simple. Entry number 1, by the way, going back here, oops, right there. Entry number 1, you can set up what's called a limit order as it's coming into your zone. That's easy. And you don't have to set it as it's coming in. You can set up that order way before it gets to your zone in preparation for it to happen. Entry number 3, usually you have to set up what's called an activation rule or conditional order. And you're setting up a stop limit order. So that way the stop gets triggered as prices leave the zone. The limit prevents you from chasing price beyond the zone too far. So use a stop limit order, but you have to set up the activation so that stop limit order does not get activated until prices come into the zone. So once again, in the videos in the E-mini Think Tank, I actually show you how to place those types of orders. And regularly during the week, as we are looking at the markets live, I actually set those types of orders up so you can see them in action as I'm placing those orders. You know, for instance, if I go out, let's see my platform here. That's the NASDAQ. Let me go back to the S&P like I was saying this morning. So here it was this morning. Oops, cancel. There's a 5-minute, I was on 15, I believe. There we are. And this is the zone that we were just looking at. Here we go. Right here. So there's the test of the zone. So once again, if I was ready to enter with the limit entry, you could have set that at any time. You see right here, 9:45, 9:30, that's the opening bell right there. So I could have had that order ready to go as soon as I was doing my research this morning on the markets and identifying that. And then, of course, when it hits the level, great, we're in. Now, if I was waiting for it to come down to the zone, we're not there yet. What I would do, click to buy. I would set up, as I mentioned, a stop limit order where I'm going to enter. If we break out of the zone by one tick, I'm going to allow for a little bit of slippage, but not too much, just a few ticks. However, this one's not ready to be put on because prices are well above the level. So I have to say, I'm going to trigger this by condition. When the price of that security goes less than 42.81, then trigger the order. That means that's the condition. This will not put in that stop limit order until prices go into the zone. And it's a little different depending on the platform you're dealing with here. This is Omega Charts that I use. And this allows me to set that order up ahead of time. It's really nice. And you can see it was a very good opportunity. The prices rallied out of that area. But again, by scaling in, I have those opportunities. Now for entry number 2, you have a couple different ways of doing this. One, I can simply watch as we're inside the zone and look to see if we start moving in just a little bit to the upside, seeing some bullish pressure. But the easier way to do this would be to drop down to a smaller time frame. So here, if I go to a smaller time frame chart, I'm basically taking a microscope to the price action, and I'm seeing more details. So as you can see, we came into the zone with lots of selling pressure and red candles. However, we started bottoming out here. We made a slightly higher low on that first green candle inside the zone, but we didn't break to a new high yet. Made another low, made the same high. However, the very next candle here, we made a higher low. And while we were inside the zone, we actually broke the highs of those previous candles. That's a bullish signal while I'm inside the zone. And I only get that by looking at smaller time frames. So I went down, in this case, I went down to a 1-minute time frame to really focus on where is price turning around while it's inside the zone. And by doing that now, my entry point is lower than 1 and 3. Remember, entries 1 and 3 are at the top of the zone. So I have more potential reward because I'm getting in lower. I have a little bit of confirmation that the prices are working. I'm sorry, the zone is working and we're leaving that area. And I have less risk because I'm closer to my stop loss should this turn around on me. Like I said, the one drawback to this type of entry is you got to be there to watch it. Well, even if you're looking at longer term trades, you can still set a price alert, come back to your computer or even on your mobile phone now. You can set up those orders when prices come to the zone. Just take a few minutes out of your day to focus. So it's up to you which type of entry you want to do. But by scaling in using those 3 different types of entries, and you don't necessarily need to use all 3. So again, it's up to you what you feel comfortable with, but you can reduce the amount of risk you're seeing in the markets by how and when you decide to take the entry in your position. The same thing works for supply zone. It's no different. We're just looking at the opposite where we're moving up into supply. We can simply set up that limit order for when prices come into the zone. We simply go sell. But we don't have to enter with our full position if we choose not to. If we want to reduce the risk, we take a smaller position. We kind of dip our toe in the water again before diving in. Once again, if we want to, we can drop down to a smaller time frame, but you must be in front of the computer to see this, and you can look for some sort of signal. Perhaps we're making lower highs and, more importantly, lower lows in price. And if you see that change in momentum where the supply zone is actually holding and turning down, now you add more into your position. Of course, you're also going to be getting in higher in the market, so that gives you more potential profit. And you're also selling closer to your stop loss, which reduces your risk. If you choose to, you can also pick up the 3rd entry, which works the same way. Stop limit order as you are actually leaving the zone. Now you have confirmation the zone is working. That's exactly what you expected to have happen. And you're taking advantage of this before it leaves and you miss out on the opportunity. The biggest warning I have with the number 3 confirmation entry is do not chase price. Now you got to be careful. You still need to enter very close to the zone as it's leaving. The further away from the zone you get, the less reward you have and the greater your risk becomes because you're getting further and further away from your stop loss. So we want to enter close to our stop loss. So that way, when we're wrong, we have very little loss. Now, that's a key. We don't have to be right all the time. We don't have to be right a majority of the time. But when we're wrong, we have to lose very little in relationship to our potential gains. And by doing that, we don't have to be right. We can be right 40% of the time and still be profitable as traders. Now, I'll show you some of our ratios right now in the E-mini think tank, and they're not as high as you might think. Some people think you have to be right 80% of the time. You don't. That's undue pressure. You're beating yourself up for no reason. You just have to manage your risk properly. I had a friend of mine who was an instructor and also a trader. He actually used to be a market maker it's for stocks, meaning he worked for a major brokerage house and created liquidity by making markets in the stocks. He would take 10 stocks that students would call out, whatever 10 stocks the students wanted. He would flip a coin. If it was heads, he'd buy. If it was tails, he was short. And by managing the positions, not choosing the positions, but managing them, because remember, it's a coin flip, he was able to be profitable by managing the positions properly. So risk management is so much more important than necessarily picking the right direction all the time. If you can manage your risk, you can be wrong more than you're right, or even flip a coin. I don't recommend that, by the way. He knew what he was doing, but you could potentially flip a coin and still be a profitable trader. It's kind of crazy. I don't think I've ever done it myself, but I've seen him do it multiple times. Anyway, this is one of the idea pages I just wanted to show you from last week in the E-mini think tank. Every one of my sessions starts off with one of these. And this was, I think, the second page. I actually had 6 ideas that day. So on the second page, you can see not every trade works out. What I do is I come up with trade ideas. And these are educational ideas that I've identified in the markets prior to the entries. And some of them are for longer term swing trades. Some of them are, as you can see here, day trades. I have a 10-minute trade on, should say 10-minute chart on gold. And that one did not work out. We ended up getting stopped out for the $180 loss. Again, it happens. And then we had a 5-minute chart trade on the NASDAQ, which did work out. It hit both targets. Now, what you'll notice about these picks, it's very rare that I'll only have one target. I typically scale out of positions as well. And the reason why I want to scale out of positions is I want to try to make as much money as possible for every single winner. Of course, that balances out the losers, right? If we take small losses, but we get very big wins, then we're likely to be successful, even if we don't win more than we lose. But how do you hold on to a winner? It's hard, isn't it? A lot of people identify these trades, they get in, and as soon as they get in, they become a nervous seller or a nervous buyer if you shorted, right? As soon as you're in, you start thinking, "Who should I get out now? Do I have enough profits, or is it going to go further? Is it going to turn around? What's going to happen?" You get all these thoughts in your head. Again, it's a psychology. Think about this. If you go to a casino and you go to a blackjack table, let's say, for instance, you throw $100 down on a blackjack table and you win your very first hand. Congratulations. So now, if you're smart, you pull your $100 that you won, or your initial $100 investment, pull that off the table and put it back in your pocket and don't touch it. That money that's still on the table, your profits that you receive from the house, the casino, what do we call that? There's a nickname that people like to call that money. Anybody know? The winnings that you had in your first hand, you took back your initial investment. Now you get to play with what? Everybody's still awake there, right? Any answers yet? There we go. Thanks, Paul. House money. Yeah, exactly. You're playing with house money, the profits. There you go. Yep, Jim, you got it. Robert, you got it. House money. Yeah. So the house money is, in effect, I mean, it's still your money. You can walk away from it. If you're not a casino guy, that's fine too. Yeah, I don't like to gamble. It's entertainment for me if I do. You know, I don't expect to win money if I go to casinos, just for entertainment. But it's house money, okay? So just think about this. You are very connected to your money. Most people are very emotional when it comes to your money. You like to keep it. You like to grow it. And that's why we're doing this. Let's face it. We want to grow our money, either for income or for wealth. So we become very emotional. When we do emotional things and make emotional decisions, they're usually incorrect. That's why when you go to a car dealership, they try to get you into the car to drive the car first. They talk about the emotions. How does this make you feel? You really look good in that car, right? Aren't your friends going to be jealous of you in that new car? They're playing your emotions because you're willing to make bad decisions, or you're more likely to make bad decisions when you make them based on emotion versus logic. You know, the right way to shop for a car would be to do all your research, do all your analysis before you even test drive the car, work out the deal. So that way test driving the car is just, if I like it, I'll buy it. If not, it's no big deal, but I've already worked out the best deal that I possibly could get. Well, going back to the house money, if I'm playing with the house money, I am not as connected to that money potentially as the money I walked in the casino with. The same effect happens here. If I have multiple targets, take for instance here on the NASDAQ trade, okay, you see there were 2 targets, pretty good targets, especially compared to the risk. Who cares about a $180 loss if you make those targets on the same day, right? So going to the next trade, or this trade, excuse me, there was an entry, okay, and guaranteed if you didn't get in there, if you got in here on the second test, as it was going down, you're feeling pretty good. Even here, let's say you got in here. As it was moving down, you were feeling pretty good, but because you didn't book any profits yet, how do you feel when you start seeing it creeping back up or even going back to where you got in? Right? If you've ever been in a position, you probably felt that nervousness, that stress, where you see, oh man, I should have gotten out. It's going back. I'm probably going to lose now. If you ever had a winner turn to a loser, you know the feeling. So you're scared until you get some profits. So right here, as we're moving to the downside, once those profits were taken at target number 1, now we have been paid for our work. The rest is house money. And we're going to be more likely to hold on to those winners and let them run rather than being nervous and exiting out too soon. So pretty much in every position that I take, I have multiple targets. So that way, when prices do pull back, because they don't just go straight up and down, they only seem that when you're losing. But when they do these pullbacks, you're not as nervous because you've already booked some profits. Now you're playing with house money. And of course, we can have a trailing stop to help us get out as well if the trends happen to change on us. But to me, it's important to have some sort of a profit-taking mechanism as we're moving in our favor, take off portions of the positions. Now, granted, if you have a smaller account and you can't afford extra contracts or lots or whatever it may be, you might be limited here. But as soon as you can, it's beneficial to have those multiple positions and multiple targets because psychologically it relieves you from the stress of worrying about getting out too soon or too late because you play with that house money. So pretty much every position I do, either personal or in the classes, I do have multiple targets just for that reason. And often what I'll do is my first target is my very first opposing zone on the lower time frame on which I'm trading. But the second target is a trading, what I call the field of play, the end of the move. I go to a much higher time frame and try to hold on until the trend ends. That way I try to maximize the profits per trade rather than trying to overtrade. Makes sense, right? You don't get rich by taking thousands of trades unless you're winning a lot. What you want to do is take the right trades and right positions and maximize the profit on each one you take. The only person that makes a lot of money when you trade a lot is your broker. They get more commissions. So scaling out is a smart thing. And again, if you want to learn more about this, I do this quite often in the E-mini think tank. And I kind of talked a little bit about that earlier. I want to mention more about what it is and invite you to join me to try it out if you'd like. The E-mini think tank, we meet 3 days a week, Mondays, Wednesdays, and Thursdays for 2 hours for each session. It's from 9 a.m. to 11 a.m. Eastern. And what we do is we analyze the markets in a live environment. I put the positions in a simulated mode just because of legal reasons. We won't have any issues of front running or manipulating the markets, things like that. But it is live market data. Excuse me. And we treat it as if it were live. Everything is recorded. So if you can't make the session live, there are swing trades, as I mentioned, not just day trades that give you an opportunity to go back and put on the positions perhaps in the evening if you get to watch the video. As I mentioned, every video starts or every session starts off with me reviewing the trade ideas. Therefore, you can go out and take a look at them for yourself to increase your education on the markets and find out more opportunities and learn better strategies to help you tackle those markets. So this is, again, one of the idea pages. As you can see, this was mixed. We had 2 day trades. This was on heating oil and gasoline. And then on the S&P and on soybeans, those were longer term trades. So it was a little bit of mix. Let's see, Bear saying today TD charges by the number of contracts, not a fixed amount per trade. Yeah, so maybe a little bit different. Absolutely. Oh, so I'm sorry. One trade of 10 contracts, the same as 5 trades of 2 contracts. Oh, there you go. So if you're getting commissions by the number of contracts, it makes it even smarter for you to scale in and scale out because you're not paying extra for that. Absolutely, Barry. So that's great where you're paying the same commission regardless of whether you get in all at once or if you get in and out in pieces. As I mentioned, I showed you getting in and out in pieces reduces your risk. It helps you. So the broker is helping you by charging per contract versus per transaction. You could go either way, depending on which brokerage you're with. Some of them allow you those choices. But absolutely. And also, as you mentioned, the one other issue you might have is the spread. The spread may be different when you're trying to get in. When we look at many of these securities, you should try to find securities that are pretty stable when it comes to the spreads and not too variable. That way you have kind of fixed costs when it comes to your trading. But it can happen. You can get some variable spreads as well. See, with the ES and 831.20, I don't remember. Oh, what time of day was I looking at this? Honestly, when I'm looking at 4-hour charts or daily charts, I don't care what time of day that it comes into the zone. The zones themselves, though, I usually want them to be formed during what we call regular trading hours. And as I mentioned, the E-mini think tank in the education area here, if you go into, I think it's fundamentals, there's documents and videos right here on my pre-trading routine, as well as my zoning techniques and how I find the zones, which ones are high quality. So yeah, if I'm dealing with the S&P futures, typically zones that were formed from roughly 8 a.m. Eastern to about 4:15 p.m. Eastern are better quality because you have institutional participation. Zones that are formed after those hours are usually not as good because you don't have the institutions to follow as much. But again, that's something that's a little bit more that I talk about in the E-mini think tank. So you can see just different trading ideas. This was from August of this year. And once again, some day trade opportunities. So, absolutely. Yeah, I'm glad I answered your question. So I mentioned, kind of the record of what we're doing. Is there a way to check out the E-mini think tank? Yes, there is. I'm going to talk about that. You can get a 2-week free trial if you'd like to check it out. And you get full access to everything, by the way. I don't limit it. So if you decide to sign up on a quarterly subscription, you have 2 weeks to try it out for free. We don't charge a card. Okay, so there's no chargebacks or waiting for the deposit to come back to you, things like that. No. What we'll do is if you decide to click the link to join the E-mini think tank and you click on the quarterly subscription, we bill you quarterly, but we will not start billing you until after your first 2 weeks are up. And then once it just auto renews and it never changes, we're not going to raise the price on you. It is what it is when you lock in, as long as you keep your subscription going. Now, within the first 2 weeks, if you decide, this is nice, it's just not for me, then just message us or email us and cancel. No questions asked. We just turn it off and we don't charge you. But if you like it, you just stay in. So you can see this is what I was talking about right here. In the month of May, I only had an 18% win rate. You're thinking, man, that really sucks. Well, no, not really. I only had one loss at 2% rate, and most of the trades were just never entered. And here's the key thing. It was not a great ratio, but my average win was double my average loss. Typically, I strive for 3-to-1, and that's why you don't have to be right all the time. So even though I had 18% winners, again, in a hypothetical account, we had a pretty good return for the month. And you can see based on what size account you might have, there was pretty good returns. And this is not just a one-off. That was May. If we go into June, you can see that I did a little bit better, 26%. So 17 winners, 7 losers, 40 no trades. They either didn't come into the zone or there's a disqualification for that as well. There are certain reasons why I will disqualify a position. And I teach that as well. We didn't do quite as well on the average win versus average loss, and it showed on the total. Still positive, but not as good as I want to be. Next month, we cleaned it up better. Now, this is what I want to see. We're over a quarter right, 27% winners out of all the trades, still getting a lot of no trades. That's going to happen. But this is what I'm really proud about. The average win was $1,400. The average loss was only $300. That is the secret to success in the markets. You can see the monthly total was much, much higher than the previous months because of that. Yeah, granted, we had 27% winners. Let's see what the previous one was. That's the wrong way. June. May was 18% winners. Here we had 27% winners, almost 26%. But again, it's because of the reward risk ratio. Oh, there it was. Sorry. So we had 26. Yeah, it's almost the same. June was 26, July was 27, but the big difference in the profit was because of the size of the win versus the size of the loss. And it's managing risk properly. Not last month, August, we had 21%. We had a few more losers, but again, because I maintained about a 3-to-1 reward to risk ratio, is a little under, we still came out on top for the month. And September, I haven't put all the numbers together yet. We just finished. I'm compiling those today. But that's what we want to do, is maintain a good reward risk ratio. And part of that is scaling in and scaling out, managing your risk properly. So when you have losses, they're very easy to overcome. The American humorist Will Rogers once said, the best way to get yourself out of a hole is to stop digging. And when we're digging holes by taking losses, if we dig small holes, we can easily climb out of those or fill those holes with the wins we have. If we start trading in our shovels for backhoes, that's a big yellow machinery that digs out, then what we're doing is increasing our risk that we can never dig out of that hole. We need to manage our risk. It's important. So the big question everybody usually has is, how much is this going to cost? Well, as I mentioned, there's a couple different things we can do here. One, you can do a monthly subscription. And if you want to, that's $3.99 per month. It'll be auto renewed every month. You can cancel at any time. And then you just, at the next month, it won't be billed. If you decide you want to try the 3-month quarterly subscription, that's $9.95 per month. And you get a 2-week free trial with that subscription. So what's going to happen there is you can try it out, like I said, for 2 weeks, no risk. And we don't charge your card. You have to take the card because at the end of the 2 weeks, then it starts the subscription. But there won't be any chargebacks or anything like that. Nothing funny. You just tell us if you don't want it, move on. So that's a little bit more about the E-mini Think Tank. I'm going to kind of open up the floor to questions if anybody has them regarding the scaling in and scaling out that we talked about. Or if you have questions about the E-mini Think Tank and the process there, the program, please let me know as well. I'd be more than happy to answer those. And got finished a little bit early. So like I said, I've got plenty of time for some questions here. If you have any, just waiting to see from the group. The rate of return on the previous 2 screens and the lines. Yeah, going back here, when you look at these, the rate of return, what I did was I calculated if you had a $15,000 account, you can use day trading margins on the futures, right? Because there's certain day trading margins there. And what happens is the profit of $11,000 turned into, on your $15,000 account, a 78% rate of return on that $15,000. If you had $50,000 and you're using the full initial margin instead of day trading margins, I just calculated that out. If basically you had $11,000 profit on a $50,000 account. So that's what it was. Let's see. Is there a tab on the website to view E-mini details as far as the trades that happened? Yeah, I mean, pretty much every recording is here. So for one, let me just go into, go to last week's, the 15th. If I start playing that, you'll see it starts off with me doing a quick intro. And then right here are all the trades. Okay. And I also have what's called the trade tracker, which shows all the individual trades as well. Now, details of the classes, you mean what is in each of the classes? Well, the titles kind of tell you what's in the classes themselves, but no, actually, that reminds me, I should go ahead and do that. I'm going to write up a details of the classes. That is an excellent idea. See, I keep making the program better and better whenever I can. I get suggestions from students. So you're saying basically, instead of having to figure out what each one of these is all about, do I have like an overall table of contents, if you will, as to what you would learn by watching those videos? The answer right now is no, I don't have that, but by next week you will. Yeah. Typically do this or do that. Well, oh, you're talking about which class to go to first and kind of progression. I believe I have that. Maybe I don't. Need to do that too, progression. I get that question a lot inside the classes when I have new students coming in. So I usually talk about that. And I tell the students where to start at any time. If you have any questions like that, say, for instance, you just joined the E-mini Think Tank for the 2-week trial and you want to ask me, hey, Brandon, where should I start? What should I look at first? If you scroll down to the bottom of the page right here, you can send me a message. It comes directly to me. I can answer that for you. I get that all the time. So Question from Jim. The class recordings are done in the evening. We watch it the next day. We know what we're looking to trade. Some of the trades are day trades, which mean that you would have to be there during that day to take the position. Some of them are longer term trades where if you watch the video in the evening, when you get a chance, you could put the position on the next day or the next several days. Exactly. So it's a mix of both because I have students that are there live, but I also have students that are there watching videos in the evening or maybe in the next day. So I'm sensitive to that. And I have trades available that both participants can take advantage of that. Where if you're not there live, you still want to be able to take advantage of the information, the opportunities, I'm there for you. You know, I find trade opportunities that might be triggered the next day or the next week. Yes. Rosemary says, I wanted to share them in the E-mini and Brandon's phenomenal. Shares incredible. Jump in and try. Thank you. Thanks for the feedback. I appreciate the feedback, both positive and negatives, things I can do to make the program better. This is not my program. It belongs to my students. So whatever I can do to make things better for them, I do. Let's see. Dory's asking, are the big banks supposed to do this level of controls on client accounts, the charge management fee? I'm not sure what you mean by that. I mean, if you trust someone to trade your money for you, they're going to charge you a fee. Yeah. So I'm not sure what other control you mean, but if you give them discretion, they have full control over what they're going to do for your investments, and they're going to charge you for it, especially if you're asking them to do the work for you. What I try to promote are people doing it for yourself. Even if you're looking at longer term investing in the futures markets, keep an eye out for that. How do you manage multiple possible trades to see if you want to get in or not? I actually talk about rating the positions and seeing if they're right for you. So there are some videos in there that talk about how to determine which one of these positions is perfect or is good, or which one should you possibly pass on. And it's an individual choice. What's right for someone may not be right for someone else. So you need to figure out, okay, I was provided with, let me show you here. Go to 9:15. These are the trade ideas from last week. So for instance, we had a 15-minute trade on crude oil. These were all day trades. Russell was a short, Dow was a short, and the Japanese yen was a buy. So we had 2 no entries, and I didn't see the follow-ups on these yet. So what you would have to do is take a look at the position and see, do you like the position? Is this something that you feel comfortable with? And that's why I also put in the amount of risk per contract. Okay, so I put in the reward per contract because, again, risk management. If you're not comfortable risking $200 for this Russell trade, you've got 2 choices. Sorry about that. Choice number 1, don't take the trade. Or choice number 2, use micros. You can use the M2K. So there's a couple choices there. Now, one thing you can't do necessarily is change time frame, because I found this on a particular time frame. You'd have to see if there's actually still a good zone on a different time frame there. Yeah, so it's entirely up to you. And like I said, as I go through these were some day trades, no entry, no entry. I do the follow-ups on these as well. Nat Gas, 4-hour long. Here's one, copper, that was a no entry. And the reason why was the momentum was in the wrong direction. The RSI is an indicator that I use to help me with identifying whether I should even take a position. And in this case, because the RSI was showing too much bearish momentum, the demand zone was not likely to work. So there are several characteristics and reasons why I would cancel a trade, and they're all listed there as well. So let's see, Dory's mentioning additionally account loss value because there was no control, even though it was a managed account. Yeah, I would definitely fire that broker and maybe do an investigation using FINRA. If you have an issue with a broker that's managing your account and seeing that it's mismanaged, you got some suspicions, you can file a complaint in 2 places. One is called FINRA. FINRA is the body of the government body that regulates the brokerage industry. You also have the SEC. Okay, and that's the Securities and Exchange Commission. Both of those websites, you can just do, I think, .gov or .com, I don't remember, but you can look into the brokerage actions that they took, and they'll take it seriously. They'll investigate with you and see if there's any malfeasance on the part of the broker, or if they were, again, it depends on the paperwork you signed and how much discretion and control you gave over your account to that broker. But when you think about it, if you're paying them, you want to make sure you're getting what you're paying for. And that's why I've always been a big proponent of, even if you don't do it for yourself, understand how the markets work properly. So that way you can have an educated conversation with your broker, financial advisor, to know what they're doing and see if they're doing something that is in line with your goals and your needs. And if it is, great, pay them. If they're doing it well, pay them. They earned it. If they're not doing well, have that conversation with them and find out why, or switch brokers, or do it yourself. But not everybody wants to. So that's what I'm saying. You're open to do all those things. Great questions, by the way. Love the interaction. I try to promote interaction in classes. People always joke with me. I tell them I'm genetically engineered to do this because my father is a retired stockbroker. My mother's a retired school teacher. So if you blend the genes of a teacher and a broker together, it's what I had to do, right? I was forced. Anyway, I love it. I do enjoy looking at the markets. I enjoy talking about the markets and even trading. I mean, I trade the markets and I love talking about it with other people that have the same interest. Looks like I'm getting a delivery today. FedEx showing up now. What's my outlook on the broad market, the SPX? Oh, sorry, my dog's going to bark at the FedEx guy who's singing on his way up to my door. You get him, Lucy. All right. My 17-pound French bulldog's going to take down the 200-pound FedEx guy. Or at least she thinks. Yeah, so look at the big picture. I'll just show you real quick. I'll go out to a weekly chart, and this is the S&P futures. I can bring in the SPX index, which is very similar. So if I go to the indices there, we'll just do SPX. Oh, thank you. I'm glad you like the painting. The copies will be available very soon. You'll keep an eye on my Twitter. I'll let you know. On the weekly chart, we're still relatively bullish, but we definitely lost momentum. This is my RSI, and it shows that we're losing momentum, but the weekly trend is still up. I would think that this is really the low that's in control, or what we call the candle in control for the trend. So unless we break that low, the weekly bullish trend is still in effect. And that's about 42, 33, 13 on the index. However, when you go to the daily time frame, things have changed. Here, we are actually in a downtrend. And it was preceded by several warning signs. But looking at the daily chart here on the SPX, what happened, first of all, the definition of a downtrend is lower highs and lower lows. And that's exactly what we see here. Here's your lower high. Oh, sorry, first high, I should say. And then you have this lower high. It was confirmed pretty much this week by breaking down to fresh lows. You cannot be physically in an uptrend if you're making lower lows. So we have lower highs and lower lows. Additionally, this RSI, I focus heavily on that in the E-mini think tank as well. You know, the bonus videos here. I have videos on how I use the RSI. Find it. There it is, relative strength index. And I use it completely different than the way most people look at it. People think overbought is going to keep continuing. I'm sorry, overbought is going to reverse and oversold is going to reverse. And I don't look at it like that. I look at this as a momentum indicator. And if you are overbought, you're likely to keep going. It's called a trend. If you're oversold, you're likely to keep going. It's a downtrend. It shows me how much momentum is there. So just as a quick lesson for you guys, I don't want to get too deep into it, but taking a look at the midpoint here, which is 50. There we go, peg that. When you're below 50, it's measuring bearish momentum in the markets. And as you can see, the bearish momentum is getting stronger. We're going well below 50. So when you have a lot of bearish momentum, you're probably in a bearish trend. However, we're going to get a little correction. And we're seeing a pop to the upside today. The reason why is as prices are moving down, in order to maintain a trend, you should be seeing more momentum. And what this is showing me is called a negative divergence. I'm sorry, this one's positive divergence. I misspoke. And with a positive divergence, it's basically saying we made this new low this week with less bearish momentum. That's not sustainable. And that's why we got a green candle today. We got a pop to the upside. Long term, that means nothing. We're not going to turn around here. But short term, it means we're going to pop to the upside, give you another chance to sell before we drop again. And looking at the daily chart of the S&P index, we have no daily demand anywhere nearby. We could break 4,000. Honestly, the nearest demand was here at 4,100. It's already been tested. If I'm looking for something that has not been tested, it's down here, just under 4,000. So long term on the SPX, we have some issues right now. Well, not really. If you like to short, then you're fine. But if you're long, again, your 401ks, everything like that for the bigger time frame, the weekly is not broken down yet. You're still okay. But if we break that low that I mentioned, and we start heading down more with the bearish pressure, if we don't make new highs, basically, if we can't get above 60 or even 50 on the next rally, then we're going to drop to fresh lows and probably down below 4,000. That's where I see it going. So today, yeah, we got a little bounce, but it's not going to last. So that's what I'm seeing on the S&P. You can see this on the 4-hour chart, same divergence or similar. Oops. Right there. You can see we just don't have the same momentum we had before, but it doesn't mean we're going to reverse. It just means we're getting a little bounce. And we may just come back up into this 43.50 area before we drop again on this 4-hour. It's another area of supply right there. Not the best, but it's something. So there you go. Yeah, I do look at chart patterns. Jim was asking, I hadn't heard you talk about Head and Shoulders. Do I talk about chart patterns like that? I believe it was on the 60-minute chart. We had one. It was kind of weak. There's a little head, left shoulder, head, right shoulder breakdown right there at this peak. Wasn't really that great though. But yeah, I look at chart patterns. Absolutely. Bull flags, bear flags. I didn't mention, but I'm a chartered market technician, or CMT. There's about 2,500 of us in the world. And there's, by the way, that's been around since 1983. There's only 2,500 CMTs. There's about 700 people that test for it every single year. And basically what it is a master's degree in technical analysis. So I've learned here at the CMT Association, I've had to learn pretty much everything there is to know about technical analysis and charting and the way you look at markets, all the different theories and all the different patterns. You know, if you go into, is it this one? No, CMT program. There's 3 different levels for the testing. And level number 1 is just a multiple choice exam where they, and I show you under explore a little bit here. Doesn't show you what it is. Curriculum. Oh, well, anyway, it goes into real in-depth analysis about the markets, all the different ways of analyzing the markets. By number 3, test level 3, it's an essay exam. They give you a booklet of charts. You have to act as a fund manager and explain where each one of those markets are going to go and how you would divest or invest your money in the different markets and explain all your answers and why. So it's not an easy thing, but it gives you a real good comprehension of how the technical analysis works on pretty much every security that there is, even alternative securities. So it's kind of cool. And I've been able to use a lot of that knowledge, obviously, to help my students understand the markets better. But I want to keep it simple. You know, I had to learn over 745 technical indicators. You go into some of these indicators and they might be fun to look at on the chart, but honestly, do you need them to make money? No, probably not. So right here, you go to indicator and there's a lot of them there. Yeah, I know what they're all measuring, the measurements themselves, like the calculations, but I want to keep it somewhat simple in my chart. You notice I just use the RSI and price action. The daily has a head and shoulders. I didn't notice it really. Let's take a look. Possibly the problem with the head and shoulders here is it's sloped in the wrong direction. Traditional head and shoulders slope upwards, not downwards. See, I'll just delete it. The neckline that you're seeing is, I'm assuming this, right? Where you've got this little left shoulder, head, right shoulder. Yeah, it is a possibility. The problem is, again, the majority of head and shoulders should be sloping upwards, not downwards. That's why I didn't really notice this as a head and shoulders. Could it work? Yeah. The problem is when it breaks, most people think the measurement of the head to the neckline will be duplicated, and that's not really true. It only goes about 60 to 70% on the break on average. So that would take us somewhere in the neighborhood of 4150 area. So anyway, I got to get going myself, but yeah, this is a possibility. Obviously, I'm seeing other things in the market that are pointing the same way to the downside. So we'll see if it is. You were saying 816, 92, and 924. Oh, for your head. Yeah, that's what I have. 816, left shoulder, head, right shoulder. Yeah. But again, the neckline is sloped the wrong direction. Could it work? Absolutely, it could work. But the reason why I was bearish was not because of the pattern, but rather what I was seeing with the momentum and just pure price action itself. Keep it simple. So anyway, I'm going to get going. Like I said, if you're interested in hearing more about all this, I would love to have you join me in the E-mini Think Tank. You can try it on the monthly basis, try it for 1 month if you want, or you can try it on the quarterly subscription, and that'll get you the 2 weeks free to try it out. You just click the link that Amy's putting up there, and as I mentioned, it'll take you out to the website. And yeah, if you have any questions, let me know. I'd love to hear from you. That's the page right there. You just see register for E-mini Think Tank, or you can click out on the bottom. The quarterly comes with a 2-week free trial. We won't charge a card. You can check it out, and you get full access to everything. So until next time, everyone, trade safe, trade well, and take care. And thank you for being here. And I'll see you in class, Rosemary. And thank you too, everyone. Alan, thank you. Thank you, Jim.